Real estate investment trusts, REITs, are a popular option for investors seeking to diversify their portfolios without the complexities of directly owning and managing property. Offering a blend of steady income and growth potential, REITs provide access to the real estate market in a way that is accessible and cost-effective. Understanding how REITs work and why they are advantageous can help any investor build a more balanced and resilient portfolio. What are REITs? A real estate investment trust, REIT, is a company that owns, operates, or finances income-generating real estate. These assets can include commercial properties, such as office buildings, shopping malls, and warehouses, as well as residential buildings, hotels, and even specialized real estate like data centers or healthcare facilities. REITs pool money from numerous investors to purchase or develop properties, allowing individuals to earn returns without directly owning or managing real estate. REITs operate similarly to mutual funds, where investors buy shares and receive a portion of the income generated by the underlying assets. The primary appeal of REITs lies in their ability to provide both capital appreciation and regular income through dividends. How do REITs work? REITs must meet specific regulatory requirements to maintain their status. In the US, for example, they are required to pay out at least 90% of their taxable income to shareholders as dividends. This structure ensures that most of the income generated by the properties is distributed to investors. REITs make money primarily through rent collected from tenants or interest from financing properties. There are two main types of REITs. 1. Equity REITs. These own and manage physical properties, generating income from rent. 2. Mortgage REITs, MREITs. These provide financing for real estate projects and earn income through interest on loans. REITs are traded on stock exchanges, making them highly liquid compared to traditional real estate investments. Investors can buy and sell shares just as they would with any publicly traded stock. Benefits of investing in REITs. Portfolio diversification, REITs, allow investors to gain exposure to the real estate market without requiring large capital outlays or direct property ownership. Real estate often behaves differently than stocks and bonds, offering diversification that can reduce overall portfolio risk. B. Steady income. One of the most appealing aspects of REITs is their ability to generate consistent income. Because they are required to distribute a significant portion of their earnings as dividends, REITs can provide reliable cash flow, making them particularly attractive to income-focused investors like retirees. C. Accessibility and affordability. Traditional real estate investments often require significant financial resources and active management. REITs, on the other hand, are affordable and easy to access. Investors can start with just a small amount of money and build their exposure over time. D. Liquidity. Unlike physical real estate, which can take months or even years to buy or sell, REITs offer high liquidity. Because they are traded on major stock exchanges, investors can buy and sell shares quickly, providing flexibility and ease of access to funds when needed. E. Professional management. REITs are managed by professionals who handle property acquisition, leasing, maintenance, and financing. This eliminates the need for individual investors to manage properties themselves, reducing the time, effort, and risk involved. F. Inflation hedge. Real estate has historically served as a good hedge against inflation. As property values and rental income often rise with inflation, REITs can provide a layer of protection for investors' portfolios during inflationary periods. Risks of investing in REIs. While REIs offer numerous advantages, it's essential to be aware of the associated risks. 1. Interest rate sensitivity. REITs can be sensitive to rising interest rates, which may increase borrowing costs for real estate companies and reduce the attractiveness of their dividends relative to other fixed income investments. 2. Market volatility. Like any publicly traded stock, REITs are subject to market fluctuations. 2. Economic downturns or sector-specific challenges can impact their performance. 3. Concentration risk. Some REITs focus on specific sectors, such as retail or healthcare, which can expose investors to risks tied to those industries. 3. For example, retail REITs may suffer during periods of declining brick-and-mortar shopping. Diversifying within the REIT sector by choosing different types or regions can help mitigate these risks. Types of REITs to consider. Retail REITs. These focus on commercial properties like shopping malls and retail stores. Their performance is closely tied to consumer spending trends. B. Residential REITs. These own and operate residential properties, including apartments and single-family rental homes. Residential REITs benefit from strong rental demand, especially in urban areas. C. Healthcare REITs. Healthcare REITs invest in medical facilities, including hospitals, senior living centers, and outpatient clinics. They are often driven by demographic trends, such as aging populations. Industrial REITs. These focus on warehouses, logistics centers, and industrial properties. The rise of e-commerce has made this sector increasingly attractive due to high demand for distribution spaces. E. Diversified REITs. These REITs invest in a mix of property types, providing greater diversification within a single investment. 6. How to get started with REITs. Research and choose the right REIT. Not all REITs are created equal. Look for those with a strong track record, solid management, and properties in high-demand locations. Consider the dividend yield, payout ratio, and overall financial health of the REIT. B. Use ETFs and mutual funds. If researching individual REITs feels overwhelming, consider investing in REIT-focused ETFs or mutual funds. These offer diversification by holding shares of multiple REITs, spreading risk across various sectors and regions. See, monitor and rebalance. Like any investment, REITs require periodic monitoring. Economic conditions, interest rates, and market trends can impact their performance. Rebalancing your portfolio ensures your allocation remains aligned with your goals. REITs offer a compelling way to add variety and stability to an investment portfolio. With benefits like steady income, diversification, and professional management, they are a practical choice for both novice and experienced investors. While risks like interest rate sensitivity and market volatility exist, careful selection and diversification can mitigate these challenges. Whether you're seeking growth, income, or a hedge against inflation, REITs provide an accessible and effective pathway to real estate investing without the hassles of direct property ownership.